Good morning, Vietnam. Just kidding, I'm not in Vietnam, I'm in San Francisco. Oh, must be second best. All right, so yeah, so what happened yesterday? I just want to, just for accountability, like I told my good friend here, who watches the channel also, Chetan. He said I should add all of these things anyway. So he's following the channel. So I just want to. I told him I'm doing this for accountability. So, okay. So yesterday I put in the sell order for the targets that I thought were going to hit here, and I said there was some very thick. There was a very thick support at that level, and it seems that those levels have dispersed. Those support levels have dispersed. You can see that they have shifted up to this area. So we do still have the H1 here, but you can tell that they have a little bit diverged now. So my original sell was here. We do still have some. I still am able to target at 100 and 200 pips from that sell, this H4 and this H1. Now, what I should do is I should have put in a stop at a polarity level, and that's why I've recorded these polarities. So that's what I'll do next time. And also the trend lines. So I should not have entered unless it broke one of these, just a regular trend line. This is not an average, it's just a trend from a low to a higher low. See these higher lows? We've got a 3-touch higher low here. So if the price crossed this regular trend line from a higher low, right, from higher lows, then I should have entered. So if the sell, but you see it did not at that time, it didn't. So next time I'll do that. I'll wait until it crosses, and then when it does that, it will also let me make a corresponding inverted descending trend line, and that will serve as the stop. If it crosses that, then I will stop out of that. And also polarity, use the polarities at those, around those points. If it crosses a polarity and a trend line, then you know that that's definitely you should stop out. You should get out of there, out of that trade. But at this point, because I've tested this so much, and I know that how this these averages work, I know that eventually it will come down into one of these areas. But usually, as standard practice, I shouldn't do that. Shouldn't keep the trade on. So this is pretty much like dollar cost averaging. I'm just keeping whatever orders I have on, and then buying at a higher price in order to get more out of it. So this will continue up, and then I'll just keep targeting these, and I'll bring up the target if I need to. But it should end up making some money. This target also, I believe I do have. No, I don't have a target on there too. Okay. So I'll just keep it down here. I'll keep these two down here on the H1 average. So this is the H4 average. This obviously is going to hit first, and this is a longer time range. You might see some bounce, some retrace on the H4 because these are longer time ranges. This is also a daily. So definitely it's going to be, it's actually going to be attracted to the H1 first. But so this is a very good sign for the H1 to be, to the shorter time frame averages first. So this is a good sign that the H1 is much lower than these longer time frame averages. This is a very good sign. This means that it's very possible for it to go through all of these averages in order to average out at the H1. Until we start seeing this H1 cross above these longer time frame averages, then I should assume that it's going to cross into here. We'll still make a lot of money. So yeah, that's it for this. And also I want to show that the yen, so actually just to recap that this is the average chart, but when I go to the other chart, it actually has not, it's actually still technically in a very strong uptrend. So it hasn't even crossed this, this lower high trend line. Until it does that, it's not even suggestible that it's reversing or in a downtrend. So I'm still waiting for that even to just think that it's stopping the uptrend. So as you can tell, it's definitely going. That's what it did yesterday. It just increased the uptrend. So as far as the yen, these are, I also want to reference the averaging strategy to make sure to let you see that this is not a fluke. This is actually how these charts work. These time range, these are the time range averages on the USD JPY. So I'm going to run that as well. And later I could run it on more pairs. So we're doing the same thing. Is you're going to average back to the largest time frames. So if we see here, we've actually got. We know that this is. I know if I start out on the longest time frames, just do that first. We see that the longest average is down. So we know that this pair is highly overbought, which means that's the US dollar, right? And all charts show in the longest ranges that the US dollar is going towards weakness. So right now it has short-term strength and long-term weakness. And that's essentially what it looks like for the past 50 years since 1971, is that there was a drastic decrease in US dollar prices. So unless there's going to be a revolution, and you've heard that, that's why you've heard the US government talk about they have a revolutionary presidential cabinet, because that's what it will take to turn the value of the US dollar around. It would take something revolutionary. It would take something totally different than what it's been for the past 50 years since 1971. And that's just not going to happen, I think. So they're essentially fighting a weak U.S. dollar, and they're going to lose because it's basically the world versus the United States, and they're already in a state of weakness. So, and they have been for the past 50 years. So they're in a short-term strength, fighting this weakness, and it's just a matter of time until that corrects back. So. This is the average. This is where it's correcting towards, but it obviously is fighting that a lot. So the next average target is this weekly average. This is the monthly average, the weekly average. This is also down, long-term target. So all the long-term targets show selling the USD JPY. So that being said, that considered, if we look more into this, we can see there's the weekly again, there's the monthly. So eventually it will target this, but we're talking about this is already like 3-4 years right here, right? This is like 3.5 years right here. So if you're willing to wait 3.5 years, then okay, fine. But if you're not, then we've got to look closer into the shorter time range averages. So the daily average is actually up. So if you're dollar cost averaging, you could try to hit this daily target, but this daily target will decrease slowly, day after day, month after month. As we're looking closer, there's the daily, and this is the H4 and the H1. So these averages also, which means that currently in the short term, it's oversold. So, and that's about 325 pips away, right? This intersection here, this H1, H4 intersection. Intersections are very strong indicators, of attraction. So this is about 320 pips on the buy side. Okay, so if you want a short-term target, then you should be buying. Now, if we look closer to that 325 pip target, if we look closer, it gets even more visible. There's about 320 pips right there. You can see that intersection right there, 320 pips. And now we're talking months, right, instead of years. This is the H1. And we've got two lower term targets, the M15 and M5. This is the M15 and M1. Two lower terms, M15, M1, and the M5. So because the M15, if we look even closer into the M15 here, the M15. So this M15 average is about 40 pips away. So it's possible that it uses this as a support, and you can see there's an intersection here. So it's possible that it uses this intersection as a support, averages out the price here, and then uses that as a support to this target, to this longer term target, which is a M5 time range. But it's definitely going to then use that as a support to get up to these two longer term time ranges, H1 and H4. So there's a couple of things that can happen. Is it can use this as support, go down and average on this intersection, come up to here, use this as support, like it did this, using this as support, and then come up into this H1 and H5 longer term averages. Now it can either do that, or it can continue decreasing in price. This is about 300 pips away, or it can continue decreasing in price and bring these two averages down slowly and slowly. So what you're doing is you're dollar cost averaging into it until you finally, eventually, that one of those dollar cost averages entries hit this, converge with this target, right? Finally hit this target. So, but this is definitely the target you should hit. These are the longer term ranges. So price will be influenced by this, and price is pretty much going to use these. We'll use these shorter time frame averages as support to get to this longer time frame average, whether it's decreasing or not as price continues downward. So those are the two things that can happen. And so either way, I would use this as a as a buying opportunity to hit this resistance here, this average. So I'll just leave it at that, and let's see what happens here. So I think both of these targets are looking for the US dollar. That's looking for US dollar strength, and this target is also looking for US dollar strength. Okay, so in the short term, I'm looking for US dollar strength. The long term, obviously, is the longest term, and I'm looking for US dollar weakness on the longest term. But that's in the time scale of 50 years. So I'm not even 50 years old, so that's the time scale. Okay, that's it for today.